May sound like a pretty dry subject for a chat, but what is an investment bond is a question I've been asked in various forms in the last week or so by various people, from professionals like a solicitor to clients who have them and aren't sure what they have, and the children of clients trying to sort out their parents' affairs. It's fair to say that if until 10 years or so ago you had money to invest, an investment bond would have been part of your portfolio. 30 or even 40 years ago, it might well have made up all of your portfolio. So what are we talking about? Well, back in the day, until probably the turn of the century or a little later, life insurance companies ruled the financial services industry. They were the main providers of savings, you remember endowments, of pensions, and of investments, as well, of course, of life insurance, which had and still has to some extent a special tax treatment. And this meant that money held in something which looked like a life insurance policy could be protected from tax if you owned the policy, as long as the money stayed in there. So the way these investment bonds worked was you're paid in your lump sum investment. There was a notional amount of insurance in that it would pay out 101% of its value if you died. And so there was generally, as a result, only tax to pay when you took the money out or when you surrendered or cashed in the policy. There are two types. One's arranged through a normal life insurance company based in the UK, and an offshore version, usually from an offshoot of one of those life insurance companies based in the UK, but in this case based somewhere like the Isle of Man. Now, the onshore version, as it's called, comes basic rate tax paid when it's cashed in. The offshore with no tax at all already paid, which means in theory it should grow more. And on neither is there capital gains tax to pay. That's all accounted for inside the bond by the insurance company. Now, until PEPs, personal equity plans, remember them, came along, they later became ISAs. These investment bonds were pretty much the only game in town unless you were rich enough to have your own stockbroker to look after your money. And when they did come along, those PEPs and ISAs, you could, if you remember, only pay 3,000, later 6,000 into them, nowhere near the 20,000 you can pay into an ISA today. Investment bonds also paid commission, as the life insurance companies could arrange some pretty convoluted charging structures to encourage salesmen and, yes, even independent financial advisors to sell or recommend them. Commission was banned in 2013. Most other ways of investing had by then become much more tax efficient. So investment bonds have become much less popular. If you already have one, well, they can provide an income very tax efficiently. As one of those special tax rules is that you can withdraw the amount you originally invested at the rate of 5% a year without tax over 20 years. After 20 years, you could, if you haven't taken any withdrawals, take the whole lot out without tax. If you do cash them in, there is a tax reckoning on the profit, as you might expect, and that will happen when you die, although I guess not your problem then. Now, that tax reckoning involves some pretty complicated sums and means filling in a tax return. There's high rate tax to pay for the onshore version and basic and high rate tax to pay potentially for the offshore version. It's worth saying that investment bonds have always been pretty widely used for investments held in trust because, as we've discussed, they shield the investments inside them from higher rates of tax, and trusts do pay higher rates of tax. Their ownership, who actually owns them and has the tax to pay, can be transferred bit by bit, if necessary, to the trust's beneficiaries. Now, yeah, I'm at risk of getting a bit technical here, but the main message is if you have one, it's not a bad thing. and most actually have a big choice of investments of where you can invest the money. The tax treatment can be good, but it's also pretty complicated. So, of course, if you have one, or if you're thinking of having one, take advice. Just, of course, what you'd expect me to say.